space stocks are, they're basically known for being absolute wild rides, right?
Yeah, completely. Total roller coasters.
And, well, Redwire is definitely no exception here. As of today, August 7th, 2026, the stock just surged, I mean, an incredible 10.35% in a single day.
Right.
It closed at $11.83, which that caps off a massive 26.6% run just over the last 5 days.
Which is a huge pop. But, if you zoom out, the volatility is it's staggering.
Yeah, exactly. I mean, it had a 52-week high of $26.64 and then a low of $4.87.
Yeah, so you're talking about massive swings.
Right. So welcome to Market Pulse Daily. Today we're unpacking this incredible disconnect with Redwire. Like, why is a company that loses so much money seeing such a massive post-earnings stock surge?
It's the classic, growth versus profitability tug of war.
Totally. But before we jump into those fundamental catalysts, a quick reminder about StockOracle. It's our favorite AI-aided stock research platform. If you're looking for fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, or just deep portfolio research, StockOracle is the tool.
Yeah, and we have a special 14-day trial link below in the description. Just, check that out.
Right, and just a quick heads up, that is an affiliate link, so the channel may earn a commission at no extra cost to you.
Exactly. And of course, we have to mention, StockOracle is not financial advice. It's not a buy or sell recommendation, and it's definitely not a trading signal service or real-time market data.
Yeah, keep in mind, AI insights and valuation estimates can be incomplete or just wrong.
Yeah.
Data might be delayed, so always verify the important facts yourself.
We just want to make sure you're armed with the right tools, but, you still have to do your own homework.
Yep, exactly. All right, let's get into it. So, looking at Redwire's top-line business operations, there are, some really clear reasons for this recent optimism.
Right. They aren't just building one specific thing. The portfolio is really diversified.
Yeah, it's not just satellite manufacturing. They're heavily involved in national security solutions, which got a massive boost from that Edge Autonomy acquisition.
Right. That was a huge play for them.
And then the one that really caught my eye, they have the Space MD division doing microgravity pharmaceutical development.
Yeah, that sounds like pure science fiction, I know.
It really does. But, I mean, look at the top line growth here. In the first quarter of 2026, they hit $97 million in revenue. That's a 57.9% year-over-year increase.
Which is just explosive growth for a hardware-focused aerospace company.
And it's real money. They're actually making money off this sci-fi stuff.
Well, yeah, because down here on Earth, gravity messes with protein crystal growth for drug research, right? You get convection and sedimentation. It causes imperfections.
Oh, interesting.
Yeah, so in microgravity, you don't have those forces. Redwire uses these things called pillboxes.
Wait, pillboxes?
Yeah, specialized hardware they send to orbit. Pharmaceutical companies pay a massive premium for this because they can grow larger, perfect crystals in orbit, which directly accelerates drug discovery.
So they're basically renting out floating zero-gravity laboratory space.
Exactly, and the demand is very, very real.
Clearly. Because their Q2 earnings, which just dropped on August 5th and 6th, they featured a sales beat, but the craziest part was this record backlog.
Oh, the backlog is the whole story right now.
Yeah, $498.1 million. $500 million in the pipeline.
Right, and because of that pipeline, they actually reaffirmed their full-year 2026 revenue guidance. They're targeting between $450 million and $500 million.
Which actually beats the Wall Street consensus, right? I think that was sitting around $470.6 million.
Yeah, it came in strong. And the key metric driving all that optimism is the book-to-bill ratio. It's currently sitting at 1.92.
Okay, so wait, a 1.92 book-to-bill ratio means for every dollar of revenue they actually recognize, they're getting almost $2 in new orders.
Exactly. New orders are drastically outpacing their current ability to recognize revenue.
But, I mean, here's where I have to push back a little bit. A $498 million backlog sounds amazing on paper. But isn't a backlog just like a giant pile of IOUs if a company can't actually deliver the product efficiently?
Well, yes, that is the core risk.
I think of it like a restaurant, You have a line of hungry people out the door, that's your backlog. But you have this tiny, cramped kitchen. The demand is there, but if you can't cook fast enough, people are just going to leave.
It's a great analogy, but you have to remember, in space infrastructure, Upgrading that tiny kitchen is brutally hard.
Right, you can't just buy a new stove.
No, you're building multi-million-dollar
Yeah.
clean rooms. You're trying to source aerospace-grade titanium with crazy supply chain delays,
Yeah.
and you need highly specialized engineers with government security clearances.
So scaling up is a massive capital drain.
Huge. If they don't scale perfectly, that massive backlog actually becomes a severe operational liability.
Which brings us to the very real gravity of their unprofitability.
Yeah, the bottom line is not pretty.
No, it's really not. Despite all this top-line growth, they are burning cash. Their trailing 12-month net margin is negative 80.9%.
That is a tough number to swallow.
And a trailing EPS of negative $2.26. In fact, their Q1 net loss actually widened by $73.6 million year over year. They lost $76.5 million in a single quarter.
Now, to be fair to the fundamental research here, we do have to caveat that Q1 loss.
Right, the edge autonomy thing.
Yeah, $42.5 million of that loss was accelerated equity-based compensation tied directly to that acquisition.
Right, so that's like an upfront accounting charge to keep the talent from leaving, basically. It's not necessarily cash flying out the door for raw materials.
That's exactly. It's a non-recurring expense.
Right.
That's why we look at adjusted EBITDA to see how the day-to-day operations are really doing.
But even looking at adjusted EBITDA, it's still deteriorating, right?
Yeah.
It dropped by $6.9 million year over year, down to negative $9.2 million. So the core operations are still bleeding.
And that operational bleed is exactly why analysts are fighting over the gross margins.
Okay, yes. Let's talk about the gross margins, because this is where I'm genuinely scratching my head. In Q1, their gross margin looked pretty fantastic. It was 26.6%.
Right, a very solid number.
But if you look at the trailing 12-month figure, their gross margin is lagging at just 9.18%. So how does a heavy manufacturing company swing that wildly? Like, are we looking at a genuine turnaround with that 26.6%, or is that just some temporary illusion hiding the 9.18% reality?
It's not an illusion, but it is highly situational.
Yeah.
It comes down to how revenue recognition works in aerospace.
Okay, break that down for me.
Unlike software, where you get a steady monthly subscription, space infrastructure operates on these multi-year contracts with very lumpy milestone payments.
Ah, so they aren't getting paid smoothly.
Not at all. They might spend 2 years incurring massive labor and material costs to build a satellite component. During that time, their margins look terrible because there's no revenue offsetting the cost.
And then, boom, they deliver it.
Exactly. In Q1, they finally deliver the finished component, the client signs off, and they recognize a huge chunk of high-margin revenue all at once.
Okay, so that 26.6% shows that when a contract is fully executed, it is actually highly profitable.
Right. But the 9.18% trailing figure reminds us that their overall pipeline is still bogged down by long development cycles.
Got it. Now, in terms of surviving those cycles, their liquidity sits at $175.2 million, so they have some runway.
They do, but that cash burn is an ongoing, serious threat.
Which perfectly sets up this crazy tug-of-war in market sentiment we're seeing. Wall Street is trying to price in the bullish revenue and the bearish profitability all at once.
And it's completely dividing the analysts.
Yeah, the valuation is wild. They trade at a price-to-sales ratio of 7.62x with a market cap of around $2.83 billion.
Which, for a hardware company with 9% trailing margins, is a very steep premium.
It really is. But Cantor Fitzgerald just maintained an overweight rating and actually raised their price target from $9 up to $13.50.
They're clearly looking at the Q2 demand and that massive backlog.
But then, on the exact opposite side, you have Jefferies, who downgraded the stock to a hold. They're basically warning that the valuation has completely outpaced the fundamentals.
And Seeking Alpha echoed that, pointing out that the whole bull case, like all the microgravity upside, might already be fully priced in at $2.8 billion.
Right. So with this clash of opinions, it makes sense that the stock is insanely volatile. It has a beta of 3.15.
Yeah, meaning it's highly sensitive to broader market swings. If the market sneezes, Redwire catches a cold.
Or if the market rallies, it shoots to the moon.
Exactly.
But there is one metric here regarding market sentiment that I really need you to explain because the math feels contradictory.
Okay, what is it?
Insider flow. Over the last 90 days, there has been a net selling of 373,428 shares by insiders.
Right, the people inside the company.
Yeah. But at the same time, the MSPR, which is the sentiment indicator for insider buying, remains at a positive 78.6.
I see why that looks weird.
Yeah, I mean, if the stock just popped 26% in 5 days, and insiders are net sellers of 370,000 shares, shouldn't we be worried that the people inside the spaceship are quietly heading for the escape pods?
You'd think so, but you have to look at how that sentiment score is calculated. It's about the breadth of behavior, not just raw volume.
We mean.
So that huge 370,000 net negative is heavily skewed by a few massive block sales, like an executive exercising options to pay a tax bill or buy a house.
Okay, so one guy dumps 200,000 shares.
Exactly. But if you have 15 or 20 other mid-level executives reaching into their own pockets to buy 2,000 shares each on the open market, the algorithm reads that as broad, widespread internal confidence.
Ah, so lots of individuals buying small amounts outweighs one guy selling a massive amount.
Exactly. That's why the score is a positive 78.6. But, insider selling at a 7x revenue multiple is still a risk factor you have to watch closely.
Absolutely. So looking out to the horizon, what are the actual execution risks? What do they need to do to justify this $2.8 billion price tag?
Well, first off, the sector is getting incredibly crowded. It's highly capital intensive.
Yeah, they're competing with Rocket Lab, Voyager Technologies, AST, Space Mobile,
Right. So Redwire's moat is actually pretty narrow.
which means they have to execute perfectly. And the immediate proving ground for that is going to be their Q3 2026 earnings in November.
That's going to be the real test. Investors will be watching to see if that adjusted EBITDA can actually approach break even.
Right. And they need to start converting these massive contracts. Like they have this $1.8 billion Andromeda IDIQ contract.
Right. But we need to explain what an IDIQ actually is.
Yeah, it stands for indefinite delivery, indefinite quantity.
Exactly. In defense contracting, winning an IDIQ doesn't mean you get a check for $1.8 billion.
It's just a hunting license, right?
Exactly. It means the government has pre-approved them to bid on up to $1.8 billion worth of work. But it means absolutely nothing to the bottom line until specific task orders are awarded.
It's like getting a VIP card at a store. You're allowed to shop in the fancy section, but you haven't actually bought anything yet.
Perfect analogy.
Yeah.
Now, they are getting real orders like the follow-on orders for the Stalker systems from the Marine Corps.
Right, so the demand is translating into some real revenue.
Yes, but they need a lot more of those task orders to justify the valuation.
And then you have these crazy long-term catalysts. Like SpaceMD has a commercial mission on SpaceX's Starfall spacecraft.
The 2028 mission.
Yeah, they're planning to send 32 fuel boxes up there, which is amazing, but 2028 is a long way away when you're burning this much cash.
It really is.
So, synthesizing all of this, Redwire is fundamentally a show-me story right now.
Totally.
They need to prove they can transition from this growth-at-all-costs mindset to a sustainable, functioning operating model.
The market is demanding efficiency now, not just cool tech.
Right. So, pulling it all together for you guys listening. Redwire has this incredibly compelling narrative. 57% revenue growth, massive $500 million backlogs, but they are in a dead sprint against their own cash burn and this really lofty valuation multiple.
It's a delicate balance between undeniable operational momentum and a very unforgiving price tag.
Definitely. And it kind of leaves you with this final, broader thought. The commercial space sector today is starting to look a lot like the early days of the railroad industry.
Oh, that's a really good comparison.
It's highly capital intensive, it's super crowded, and it is absolutely essential for future infrastructure. But back then, hundreds of those early railroad companies went totally bankrupt, laying the tracks that we still use.
Right, the pioneers take the arrows.
Exactly. So in the long run, are the ultimate victors in space going to be the companies with the most futuristic, jaw-dropping technology, or simply the ones who figure out the boring, earthly math of scale efficiency and positive cash flow first?
The boring math usually wins in the end.
It usually does. Just something to keep in mind when navigating these high beta space stocks. That is our outlook on Redwire. Remember to hit subscribe so you don't miss our daily deep dives into the market's biggest movers.
And don't forget to check out the description for that special 14-day trial link to StockOracle. It is a fantastic tool to help you dig into the fundamentals, valuation estimates, bull-bear insights we talked about today.
Absolutely. Thanks for tuning into Market Pulse Daily. We'll see you tomorrow.